Well, welcome to part two of the YouTube video, and we're reviewing the S&P as of January 19th, and I've also just taken a break from the numbers on the S&P as we were going through this exercise. I have also overlaid another instrument, and this is the VIX on the continuous contract. There's been a lot of conversation lately about the VIX and as to its value, and I still think it has a lot of value, and I think it's very educational. There's an old rule of thumb that I learned some years ago from a fellow by the name of Phil Grandy, Sarasota, Florida, who's excellent, by the way, and it's called Phil's Gang. Give him a plug there. And he doesn't probably know me from Adam, but I learned a lot. This is the VIX, and Phil used to say, when the VIX is high, you buy. And that's exactly what you would have wanted to been doing down here. But people, Warren Buffett has a saying, when they're crying, you want to be buying when they're crying. And everyone was crying here because of this. But that was precisely the time you wanted to be buying. And you can see the VIX measuring put to call, or the fair gauge, over the same time that the market, you can see it was on a steady decline. And you can see these little peaks. And for whatever reasons, Ben Bernanke, Treasury, coordinated, market manipulated, probably all of that's true. They crushed out the VIX to restore volatility, and every time they crush out the VIX, the market would go higher. And here are the peaks coincide. This was the flash crash, and this is the area that Ben Bernanke did what he did with QE2, and this is Operation Twist. And here we are. A little blip in here, a little bit before for all the concern about the fiscal cliff. Here was a little blip here, crushed out, and now the VIX is at a 5-year low. The other half of it, if you want to buy when the VIX is high, when the VIX is low, you want to go. So, or as Buffett says, when they're all cheering or yelling, and they're yelling how good this market is, you're hearing it from every place, including Obama, you might want to be doing some selling. Or as another fellow that is also very good, that's Pete Najarian, saying you want to be buying some of these puts. They're really cheap to protect these profits you got. So there hasn't really been a signal here yet on the VIX, and there hasn't been a signal here yet on the market to sell or to go short. But we are. The tide here is out, extremely out. The VIX is very, very low. And the market is never calm. Don't everyone tell you that the market is calm. The market is never calm. Everyone is always nervous. The market is always nervous. And when the market appears to be the most calm, that's when you want to be the most vigilant. And I would suggest to you right now that the tide has gone out. And like we saw in those videos, in the fire in the Southeast Asia, in Thailand, when that had that tidal wave, the first thing was the tide went out, and there were some people ran out there and were picking up shells. If you have previous experience or someone can pass on some knowledge to you, you would have known it was time to run for the hills, run to high ground, not to go shelling on the beach. And I'm suggesting now is the time to get to high ground. And let me explain further. Okay, we've removed the VIX, and I just wanted to now look at where we are. So I'm going to widen this out so we can see it better. No sense fighting it. Okay, now where might we go? We're currently at 1479. If you look at the past performance of the overall market from trough to peak, with the assumption that much of this is being manipulated, generated by the Fed and the Treasury and what have you, trying to get a fire started. You can see that the move has been dropping by almost 10%, 37, 27, 17. So if you apply that as maybe as a benchmark, this is rough, not exact science here, the trough here was approximately 1350. 1353. If you apply a 10% move from this trough, that could bring the market up to a peak E of 1488. Then if you also go from the peak to the peak, the last two moves, peak to peak, have been 5%. So if we don't have a blow off top, which might be tough to do now that we've already had a kind of a big move, we got that big gap sitting under us. They may have tried to do that and it just petered out. I'm leaning more in that direction. So the 5% move from peak to peak would mean that the area that you could look for a reversal number is 1524. So we're looking for a reversal anywhere between really here and 1524, and we don't think there's going to be that blow off top. So that's the area of reversal that we think from where we are right now, 1479, most likely 1488 area, as high as 1524. And I want to bring this back down and also show you one other a Fibonacci study, and I think most people are familiar with Fibonacci. And we're going to come in and we're going to do the price extension. And we had done this, it's hard to believe it was years ago that we thought, and I never thought in a million years I was going to go there, but they did. The way we do it, we bring it up to the peak A, and then we bring it down to the C point, and I'm going to have to scroll this down. The real significant move was that move out of March 9th, and 100% extension of that move would be right here, 1502. 1502, right in the middle of our target range. So I know folks are thinking we're going up to 1600. I just don't think that we can continue. I think it'll stop. I think you should be looking for a reversal in this area. Again, between where we are right now and 1524. Keep your sizing position, but I would be tightening my stops. I'd be buying puts, and I would be looking, simply because of the fact that we are at peak E, I would be looking to short this market. We are going to see a major break, and where might the break take us? Let me show you. Okay, now I erased the Fibonacci extensions, and I drew a Fibonacci. It's amazing, these pullbacks that we've had. If you're familiar with Fibonacci, they have always pulled back to about 0.38 of the move. It's really just amazing. They almost just hit it right on the number, and I have no idea why and how these things work, but they just seem to do. So leave that to others. But if this is the peak E, and we think that it would most likely, the highest it will go is 1524, most likely going to turn around. We would be expecting, I'm not going to say guess, expecting probably as early as next week, maybe go up, maybe even go up and just touch that number, then get a nice reversal on the weekly, and then we're going to come back over a few weeks. But it could be rapid. When we fail at peak E, it's usually a rapid decline. Where might it go? Well, of this entire move, the 38% retracement is 1171. 1171. Even down to 50% would be at 1062. So we think the market will be coming back down in here. We think the risk reward is not there to be putting anything on long now. You want to be looking to go the other way and look for the trend reversal and then start down. Now, I'll leave the fundamental stuff to everyone else, but I think the policy part of this is that I don't think the market can break out from here and sustain the higher levels, despite the Jeremy Siegels of the world at Wharton. I didn't go to Wharton, I just trade for a living. But we would see the market pulling back into this area and then going sideways for a period of months, maybe even a year, and the bonds even going higher. And then ultimately, if this whole Keynesian experiment works and confidence is earned the old-fashioned way, then maybe the money comes out of bonds, maybe with a new presidency. Who knows how long it's going to take, and the market will ultimately take out these highs and go higher. Let's hope that happens, but we can't trade on hope. We're just sharing with you what our expectation is. And I want to show you one last thing.